Welcome to The Explainer. Today, we're taking a deep dive into how two absolute market heavyweights are preparing for entirely different types of financial chaos. We are looking at a fascinating clash of philosophies, analyzing the latest strategies from long-term growth advocate Tom Nash and the legendary defensive contrarian Michael Burry. Both of these legendary investors are looking at the exact same market and, well, they both see disaster looming. But here's the catch. Their survival strategies couldn't possibly be more opposite. Nash is bracing for a massive inflationary shock, while Burry is sounding the alarm on a historic euphoria bubble. So what happens when the smart money radically disagrees? Let's find out.
Okay, let's dive right into this. Here's our roadmap for today. We're going to hit anticipating market chaos, then Tom Nash's long-term growth approach, Michael Burry's defensive contrarian tactics, the great AI divide, contrasting philosophies, and we'll wrap it all up with portfolio lessons. All right, starting off with Section 1, Anticipating Market Chaos.
To really get their strategies, we first have to understand the specific flavor of chaos each investor is actually preparing for. For Tom Nash, the dominoes fall a bit like this. He's keeping a very close eye on the geopolitical landscape, specifically what he calls an impending Iran shock. And the sequence is highly logical, right? If oil prices spike, the cost to transport and produce goods literally doubles. That immediately cranks up inflation. Combine that high inflation with slowing job growth, and boom, you get stagflation. But here's the truly terrifying part for the everyday investor. When oil causes stagflation, the Federal Reserve's hands are completely tied. They can't just cut interest rates to save the economy without making inflation even worse. Nash sees this as a brutal survival of the fittest scenario that's going to wipe out weak businesses.
Now, Michael Burry, he isn't positioned for an inflation shock at all. Instead, he's terrified of a euphoria shock. Just to put this into perspective, by mid-April 2026, amidst geopolitical news like a brokered ceasefire, the S&P 500 closed above 7,000 for the very first time in history. Meanwhile, the market's fear gauge, the VIX, totally collapsed down to around 18. Every single metric of sentiment was screaming risk on. And for Burry, this complete lack of fear is exactly what makes the market so incredibly dangerous right now.
Moving on to Section 2, Tom Nash and long-term growth. Let's break down how Nash actually plans to not just survive this chaotic environment, but to build generational wealth. His strategy? It's deeply optimistic and relentlessly long-term. Now, what's really interesting about this slide is this staggering number right here, 80%. Nash strongly warns against sitting in 100% cash just out of pure panic. Over the past 25 years, if you just sat in cash, you suffered an 80% loss in purchasing power. Your dollar effectively became worth 20 cents. Nash's core belief is that simple market crashes don't kill portfolios, inflation and irrational, impulsive panic selling do.
So instead of sitting in cash or cyclical commodities, Nash is buying long-term tech compounders. A huge chunk of his thesis revolves around AI memory. Think about it. As AI tasks become 10 times more complex, they naturally require 10 times more high bandwidth memory. And right now, just 3 companies hold roughly 90% of the entire memory market. Nash's absolute favorite is the US-centric Micron. Even though it recently took a 50% drop from when he first added it, he views it as a 5-year money printer. Why? Because building competing manufacturing capacity takes at least half a decade. And that leads us right into Nash's picks and shovels shopping list. He wants companies that are mission critical. In energy, he likes non-cyclical plays that compound with tech, like CG for nuclear or VRT for data center cooling. In production, he's holding heavyweights like Nvidia and ASML. And for chaos management, he relies on Palantir, a company specifically built to help organizations make split-second decisions during supply chain or geopolitical crises. Nash's strategy is simply to use the market's temporary weakness to buy these high-quality, high-margin winners for cents on the dollar, and then just hold them for the next 10 to 15 years. Which brings us to Section 3, Michael Burry, the defensive contrarian.
Now, we are completely shifting gears to Michael Burry. After shutting down his traditional equity portfolio, Burry launched a Substack called Cassandra Unchained. He is literally publishing his trades in real time, completely unconstrained by those delayed SEC filings. And you know, when Burry makes a move, the market pays attention. We always have to remember his track record. He famously returned nearly 489% for his investors during the 2008 housing crisis by spotting a bubble that nobody else believed existed. Today, he's using that exact same framework, hunting for structural cracks to navigate our current market. On April 10, 2026, Burry published 4 massive, high-conviction trades that aggressively zig while the euphoric market zags. First,
He bought heavily into January 2027 put options against Nvidia. He also took massive long positions in beaten-down Chinese tech stocks like Alibaba and JD.com, basically arguing their rock-bottom valuations make them a historic deep value play. He went long in a disgraced payments processor, Fiserv, betting the market was way over-punishing past management mistakes. And most surprisingly, he added to an already significant position in GameStop.
Now, I know what you're thinking, but Burry's GameStop trade has absolutely nothing to do with internet meme stocks or short squeezes. He is looking purely at the balance sheet. GameStop is sitting on over $8.8 billion in cash and holds a ton of Bitcoin. Burry sees CEO Ryan Cohen as a benign dictator who has built a completely asymmetric acquisition vehicle. In a normal market, sure, it's a boring, safe holding company. But if the market actually crashes, that $9 billion turns into an offensive weapon, letting Cohen scoop up distressed assets at once-in-a-decade valuations. It's actually brilliant.
All right, Section 4. The Great AI Divide. This is the absolute core of their disagreement. The true battleground here is the future of artificial intelligence, and specifically Nvidia. While Nash sees Nvidia as the ultimate picks and shovels long-term hold, Burry sees something entirely different. He calls the current environment supply-side gluttony. His January 2027 strike 115 put options require Nvidia to fall more than 40% to intrinsically pay off. Burry believes the massive AI capital expenditure cycle by big tech is completely unsustainable and due for a violent correction. And this brilliantly illustrates exactly what Burry thinks will trigger the crash, the depreciation problem. Essentially, massive tech companies are buying Nvidia chips and quietly extending the assumed lifespan of that hardware on their balance sheets from 3 years out to roughly 6 years. This artificially inflates their current reported profits. But here is the massive contradiction. Nvidia's CEO jokingly calls himself the chief revenue destroyer because he's releasing brand new, drastically better chips every single year, making the old ones obsolete in under 2 years. Burry literally compares depreciating functionally obsolete hardware over 6 years to the accounting frauds of the early 2000s, like WorldCom.
Burry actually backs this up with a truly fascinating historical parallel. Back between 1900 and 1910, U.S. electricity production grew massively, but generation capacity grew even faster at 375%. Because supply completely outran monetization, literal pioneers of the technology, like Westinghouse, went bankrupt. Burry's warning is loud and clear. The infrastructure winners of a revolutionary technology do not always stay winners. This directly challenges Nash's optimistic thesis that infrastructure providers are guaranteed money printers.
Section 5. Contrasting Market Philosophies. So, let's pull all of this together and put these two legendary market philosophies head-to-head. The crucial point here is that we're looking at two entirely different ways of valuing assets. Tom Nash fears inflation destroying your dollar, he operates on a 10 to 15-year horizon, and he wants to buy high-quality, high-margin winners when market chaos temporarily drops their price. For Nash, all that really matters long-term is revenue and margin development. Michael Burry, conversely, fears euphoria and bubble expansions. He operates on a much shorter, crash-focused horizon, hunting for deep value, highly compressed assets that offer asymmetric payoffs. He wants setups where his downside is strictly limited, but his upside is massive if the crowd turns out to be wrong.
And finally, Section 6. Lessons for your portfolio.
So what does all of this high-level billionaire strategy actually mean for you, the focused learner? How do we apply this to your own portfolio today? Well, first off, it's absolutely vital to recognize that despite their vast differences, both of these investors agree that market crashes are inevitable. They will happen. But historically, the market is incredibly resilient. Nash loves pointing to Amazon as the ultimate example. It dropped to $2 a share during the 2008 subprime crisis, but survived and eventually hit $255 because it was a fundamentally strong business. Strong survivors create generational wealth after the chaos clears.
Ultimately, whether you're dollar-cost averaging into long-term tech compounders like Nash, or you're carefully hunting for distressed, deep-value assets like Burry, the rules for survival are exactly the same. You absolutely must avoid impulsive, emotional behavior. You need to build a strict, unemotional framework for buying. You should maintain a strong core of the S&P 500 to capture broad market resilience. And, perhaps most importantly, do not rely purely on cash, because inflation is a silent portfolio killer.
I want to leave you with a question to really chew on. Take a look at your own holdings right now. Based on the incredibly compelling arguments we've seen today from both sides of the market, ask yourself, are you building a 15-year growth engine, trusting that innovation will power through any chaos? Or are you building a tactical crash bunker, just waiting for the euphoria to snap? Understanding which game you are playing is literally the first step to surviving the chaos. Thanks so much for joining me on this explainer, and I will see you next time.